Again, we are live from our studios here in Kokomrimle in Accra. This is Joy News. Welcome to Ghana's leading business analysis program, Beyond the Numbers.
Well, this is the only show dedicated to market development, bringing you updates on deals and key headlines shaping your business day. Winston, the inflation figures have actually been released. 3.3% is what we are looking at so far. I have looked at the numbers, and many are saying that they were expecting even the figure to be around 2.5, 2.8. But you look at that 3.8% and look at other commodities. There were some top 20 commodities that still have inflation rates about 17%. And you look at, a product like, or a commodity like, onions. There's also tomatoes. Another, product like, let's say, cinemas and cultural services, all recording rates above 17%, very, very high and still significant. So although the national figure is still 3.3, you still have some disaggregated figures recording very high figures. This is very alarming considering what is happening in the tomato market. We're expecting this to happen. We predicted the rainfall pattern affecting Ghana's cocoa total harvest, basically, and what is happening in Burkina Faso. Now, our total tomato, sellers or marketers are having the challenge of having it into the market. When you go to the market now, it's quite expensive. 3 tomatoes is now going for less than 10 Ghana, more than 10 Ghana cedis. And this is going to happen consistently until we are at a place where we're able to afford or have more on the market. And that requires a whole strategic outlook in terms of policy direction going forward. Well, inflation is not just about prices. Definitely 3.3% will mean that we are looking forward to the next decision that the Bank of Ghana will make in terms of the policy rates. But importantly today, here on the show, we are not just looking at that. We will be analyzing the domestic debt exchange program that has come to an end, and the fact that government has been given the green light to come back to the market. Again, we'll take you to our top headlines. And Winston, what can we report? Now to top headlines. Government obtains green light to start borrowing from the local bonds market as 3-year moratorium comes to an end with clear plans to access liquidity for infrastructure expenditure. The Finance Ministry says the expiration of the restrictions paves the way for it to drastically reduce its dependence on treasury bills to finance its budget and allow for the issuance of new long-dated domestic bonds. And now from the fixed income markets, we move straight to the equity space where the Ghana Stock Exchange Composite Index rose to 13,731 points yesterday, gaining 2.8% from the previous session. Over the past month, the index has actually climbed 50.9% and is up, 132.5% compared to the same time last year. Market capitalization has now exceeded 200 billion Ghana cedis. Now, on the energy front, government reaffirms commitment to safeguard Ghana's energy supply amid Middle East crisis. We understand a high-level meeting was held bringing together representatives from the National Petroleum Authority, NPA, Boss Energies, Ghana National Petroleum Corporation, GNPC, oil marketing companies, OMCs, and bulk import distribution and export companies, BIDEX, and other major industry players to deliberate on the development. Still in the Middle East tension, Goldman Sachs has actually raised the second quarter 2026, average price forecast for Brent crude oil by some dollars to some $76 per barrel, and for the WTI by some $9 or 71. Goldman Sachs said this forecast remains heavily tilted to the upside, with risks including a longer than expected disruption to export through the Strait of Hormuz and potential damage at oil production facilities in the Middle East. Kofi, on the fiscal side, Ghana reference rate drops sharply to 11.7%. Major interest rate cut is actually expected. We understand that the drop was largely driven by a significant fall in treasury bill rate into single-digit range, alongside a marginal decline in the interbank rate. Now, banking consultant Dr. Richmond Etuahin has warned that the Ghana Amalgamated Trust, which is 19.1% compounded funding, meant to recapitalize indigenous banks after the crisis has ballooned liabilities, strained operations, and threatened stakeholder or shareholder control and exposed pension funds to systematic financial risk.
Now to the cocoa sector. Cocoa markets continue to boil in West Africa, with Ivory Coast giving assurance that it will to continue to program to buy residual stock of 100,000 metric tons of cocoa at the guaranteed price. Farmers had voiced concern in recent days that a stock buying program launched in late January to clear unsold cash to provide farmers after a slump in global cocoa prices could be halted as the mid-crop harvest gets underway earlier than expected.
Those are top headlines for you, and we've got more on Markets Watch and big analysis coming up in this edition of Beyond the Numbers. This is Beyond the Numbers on Joy News. Markets Watch is up next.
It's now time for Market Watch here on Beyond the Numbers. We'll go to the market to assess the Treasury bill rate, what is happening in the T-bill market, as well as the Ghana Stock Exchange. There's so much development, positive ones indeed, and we'll assess into implication with new announcement from the government opening the bond market. We'll be speaking with John Nani of FinCap Securities, as well as Grace Nomanyon to give us more insight from Data Bank Research for more analysis on this development. We go straight with Grace, who is joining us right now on Zoom. Grace, it's good to have you. How's the market been so far this week? From Monday, it's been interesting. You look at the stocks performances, it keeps getting interesting with announcement from the composite capitalization reaching about 230 billion Ghana cedis. How is the market faring?
Yes, thank you, Winston. The market is still trading strongly. Investor activities are quite strong on the stocks that are listed on the exchange, and that has contributed to the impressive performance you rightly mentioned on the equity market. On the other market, which is the fixed income market, however, we currently see some quite muted activity as investors are looking out for whatever the reopening will present.
Interesting. Grace, I want to understand from you. At the moment, we're seeing some banks, or let's say stocks, releasing their financials. It appears some attributed the appreciation of the cedi last year as one of the leading cause of their profitability going down. How does that play on the stock market, especially with these narratives?
Right. So most of companies have their cost factors. I mean, some companies on the Ghana Stock Exchange have some cost factors in terms of FX for operations. So I think the cedi stability also supported a bit, but we can't put all the glory on the cedi appreciation. I mean, internally, these various companies did their best to contain costs and other activities that brought them this far in terms of the profitability we see on the market. So yes, cedi played a factor, the appreciation of the cedi played a factor, but it wasn't a solid factor for the numbers we currently see.
Now, Grace, bring us up to speed on how the composite index has actually rallied this particular month and this particular week. Is it still tilted towards financial stocks?
Yes, even as we speak now, most of the counters that gained today are from the financial counters. I mean, notwithstanding the fact that under the financial counters, we have insurance companies such as SICB and Enterprise Group Limited, both gained today as we speak now. And then the banking stocks also came in strongly. So majority of the gains I would appreciate, related to the massive or impressive performance of the financial sector. Also, MTN, we're obviously doing about 30% of the total market capitalization, has also contributed significantly to the performance of the composite index.
John, I want to understand from you, what are investors looking out for? Is it to just get quick returns, or they're looking at the long term?
Well, I think most investors right now are quite uncertain about a lot of things. And so a lot of investors are on the short end. Although, I mean, there are a good percentage of investors are also going long on equities. But I think generally, most investors are still looking out for, what government is going to do in terms of bond issuance. Government just issued the issuance calendar for Q2. And so I believe a lot of investors are on the lookout for what products government has to offer. And so a lot of them are playing on the short term to kind of strategize towards what government is bringing. On the stock market also has seen a good number of action, but it is mostly a seller's market. And so a lot of investors are on the lookout also for stocks. However, it seems to appear that there are more bids than there are offers, and so there's still money out there that investors are looking for where to put them.
I'll come back to you on the fixed income space, but I want to take you back to the equity space, where if you look at what is happening between the US, Iran, and Israel, what you see is that most European stocks are down since Monday. But if you look at our stocks currently, the composite index is up, the financials are also up. What is the unique story? What sort of hedging do we have? What sort of cushion have we built to make sure that even though European stocks are down, we still have our market still very alive and attracting new investors?
Well, the international news usually has a lag effect. On our local market, and so I believe that eventually we would also see the ripple effect of the whatever is happening out there in our market. And so I think what we need to do is build buffers against when that ripple effect comes, right? And so, for investors in the country here, the geopolitical turmoil, you see that on the world market, oil is going up. There's been some rally in minerals and other commodities as well. And so I think local investors should be on the lookout for, gold-backed investments, oil-backed investments. Those will help us cushion the blow when the rippling effect of geopolitical tension finally gets here.
Now, Grace, still on geopolitical tensions, there's big conversation around the safe haven assets, and a lot of investors are looking at moving some of their investments and their portfolios and assets into gold holdings. Do you think that is going to affect our market in the long run? I'll take it from Grace and I'll come to John.
Right. Isaac, yes, in the long run, we might have some ripple effects or the impact of this geopolitical tension on our local market, i.e. the fact that investors are moving towards safe haven assets such as oil-driven assets. And on our domestic markets, we currently see a lot of interest on the oil companies listed on the exchange, which is Gold and Total Energies. Investors will be looking out for where to safeguard their capital or where to improve their capital. So yes, in the long run, yes, but just like John rightly mentioned, our part of the market have lag effects when it comes to impact of what is happening now in the Middle East. So yes, we expect some possible trickle impact of what is happening to affect our local market, but that's just in the long run.
John?
Yes, I think Grace has rightly said it, right? And like I treated earlier, we would have a lag effect. Our stocks or our equity right now are doing well. I think one of the major factors is because there is a lot of demand for the stocks. And so what is happening out there is not really affecting us, I should say, directly. And so I think the factors that drive the European markets or the New York Stock Exchange, for instance, are quite different from what drives our market or what is driving our market currently. I mean, until the factors that are driving our markets kind of run out, which is mainly because there is a lot of liquidity in the markets, and investors are still actively looking for, I mean, where to put money. I think we will still enjoy the ride up. You know, for a long time we have enjoyed interest rates, which is, I mean, T-bill rates on the high, and so as the T-bill rates are now in the single digits, which is quite unprecedented for a lot of investors in the country. I think we are still kind of looking at where we can find, I mean, 30% increases, 20% increases. And so I think, and the equity market is the best alternative for us right now. And so,
John, I want to get from you briefly before we go. You say equity market is the best. With the announcement, exactly, with the government announcement of re-entering the bond market, how is the market receiving this basically sentiment?
Well, I think a lot of investors are on the lookout to see what government brings out, right? The bonds, although government has issued an issuance calendar, government has only given a ballpark figure of the amount they are looking to raise. There is no news on indicative yield where government will try and issue at, right? But I think government is also, I mean, going by a certain playbook of looking to reduce borrowing costs, right? If you see what's happening on the T-bill market, it's kind of an indication that government would, I mean, if government had their way, they would borrow at very low rates, right? And so, and government being the borrower, and every borrower wants a lower borrowing rate. So yeah. I don't think investors are anticipating maybe government to come and borrow at a 20 or even perhaps a 15. I think a lot of investors are anticipating lending to government anywhere between 10 and 15. And so the stock market still provides, in this case, a better alternative, because this year alone, the composite index is up 56.6%. That's as of close of market yesterday. The financial index is up over 80%, right? And these are just 2 months into the year. And so I believe it is good for, I mean, investors who are in the money. And I believe a lot of investors are in the money this year.
Finally, from Grace, before we go, Grace, strong appetites from our investors for high yields and high interest. So John is saying that, well, he doesn't think that government can even come to the market to borrow at, let's say, 20%. How much will be too low for investors for you, from your end?
Well, I can't give a figure to it, but I think investors will be looking out for better opportunities than we currently have on the money markets and then the existing bonds. I mean, the existing bonds are doing somewhere on average 12%. So maybe investors, depending on how long the government is trying to issue, I mean, investors may want to be compensated for. I mean, the odds are that inflation is down 3.3%. So, I mean, risk-factored inflation may not be an issue at this point. So investors may just want to be at par, like where exactly can I put my foot to be best? And I think he rightly mentioned that the stock market presents good opportunities at this point. So investors may want to compare the odds. What are the odds that if I invest in the equity market, I'll be better off? What are the odds if I tap into the issuance, I'll be better? I think these are some things investors will be likely considering when they put in their best foot in terms of choosing what market to invest in.
Grace and John, thank you so much for joining us here on Beyond the Numbers. Time for big analysis, and Caleb Ziblim and Dr. Richmond Etuahine will join us after this short break, where we will be discussing the decision to reopen the bond market from the perspective of banks. Dr. Richmond Etuahine has done a lot of research on this. He will join us. And then also analyze the Ghana Amalgamated Trust, which was supposed to be a savior for banks during the crisis period, But his research shows that if we do not take time, this could end up engulfing all banks. After this short break, Dr. Richmond Chahine will join us and Caleb Zevin.
Welcome back to the big analysis here on Beyond the Numbers. So we are delving into a deeper conversation on government's decision to re-enter, reopen basically the bond market after 3 years of staying behind closed doors. Already, government has been dependent on the Treasury bill market to finance its project going forward. That has been the limited financing structure for the last 3 years under the IMF program. Now, we want to assess the risks involved going back and what we must be cautious about, considering the effects, implications that many endured investing in sovereign debt bonds. That has to do with the DDEP. So far, government has demonstrated that they can be able to fulfill their debt obligations by making sure that all maturing interests owed both domestic and bilateral creditors, they've been able to fulfill. And most are also expecting some positive B rating considering how government has been able to manage its debt. Before we get to the conversation with my colleague Kofi and Caleb, the National Petroleum Authority has issued a directive to over 300 OMCs and 30 BIDCs, basically telling them that directing all OMCs to stop discounting their fuel price. We saw some few weeks ago when fuel prices were coming down. Yeah. Some of them decided to even sell wachi at their own OMC pumps because they were attracting most customers using different marketing strategy, with some also advocating for easy access depending on how wide stretch their pumps stations are across the nation. Now, this directive coming through, many have questioned why the regulator will go that direction, considering the factors where we are operating in a deregulated market, where factors such as the global commodity price, as well as different pricing formulas are taken into consideration. However, how do you see it, Kofi?
Well, I simply do not know why we have to come to this point, especially with the MPA saying that stop all forms of discounting, right? There's already a price floor. If somebody decides to say that I'm selling at a certain price, but I'm giving my customers discount based on what I think that I've been able to get from the market or the relief that I have, I don't think that MPA should stop oil marketing companies from applying discounts. I simply do not know why this decision is necessary now, especially looking at the fact that in the last 2 windows, we've seen fuel prices go up twice, right? Mm-hmm. Now we're enjoying a price for about some 9 cedis, I think 99 pesos or 98 pesos. Then you set a new price floor, which is now more than 10 cedis. Another price floor has come. And the expectation is that looking at what is even going on in Russia, Iran and the US and also in the Middle East, you are likely to see a higher than expected price floor in the next pricing window, and you're stopping other OMCs from applying, discounts. So, how if an OMC has a certain sort of a relief and they want to give out to their customers, how do you do it if you want discount to go away completely?
Mm-hmm. Well, I think for the NPA, and the regulations allow that some OMCs have about 3% discount within some of their fuel stations. So the current regulations allow that some OMCs apply the discount. And the problem here is that there's also a regulation that says that there should be uniform pricing across the country. So if you go to any...
That can be possible. That can be possible, right?
So which is why we pay some taxes for uniform pricing. So that if your filling station is in the northern region, the transportation cost is covered by that fund. So that when you take your tankers or your fuel from Accra to that filling station, the distance that would have added the cost to make it more expensive in the northern region is taken by the government because of that fund. Which is why in Accra and in Kumasi or in Tamale, the price of petrol and diesel is always the same.
So the question is, if you want a uniform price, if you want a uniform price, why then introduce price floor?
No, so
why don't you set a national price that is fixed? There's no floor, there's no ceiling.
Again, so all of this was to protect the industry. So now some of the OMCs are complaining that because the 2 big players, Gold and Star, are competing, and some of them are offering, discounted here and there, it has distorted the market. We don't have uniform pricing anymore. You can go to a Guel station today, get fuel for say 2 cedis, go to another one, it's the same Guel, and get for 5 cedis. So the people staying around the 2 cedi filling station are benefiting from the same OMC, which some of the players say is not fair because the smaller OMCs cannot afford a discount. So either you're selling at the price floor for all your stations, or don't offer discounts at all.
It appears there are perception that there are some OMCs selling adulterated fuel on the market. Some of them also using unregulated routes to get unapproved route to access fuel from neighboring countries. And these are all suspicious allegations coming up. We hope the OMC will be up and upfront with Ghanaians, because one thing that many are looking for is the National Petroleum Authority protecting only the marketers.
But Winston, it's also clear that there are also people who have the kind of perception that all of these regulations are geared towards protecting one player in the space, right? Which is making some other players not happy, not really comfortable, that it looks like you are using the state powers to possibly protect one OMC. And you are not allowing other OMCs to use their own marketing strategies to take advantage of the market. I have my margin. I have what I'm supposed to benefit from the whole price chain. And I believe that I've reached a certain point that I can give a certain part to customers. Why are you not allowing me to issue discounts? Why are you forcing everybody to price at one price? Even with electricity, we have, price discrimination all over the country. So why should it be the same for, why should it be the case for petrol, where you're forcing almost everybody to sell at a certain price that one OMC is selling, and forcing everybody to go to one OMC, and forcing everybody to actually sell at a certain price, and everybody's saying that you're doing that to protect just one player?
You know, most have questioned the whole structure of licensing, basically. We have so many OMCs in the market. Now, it's either the MPA is unable to regulate over 300 OMCs. It's either the MPA is finding challenges in ensuring
that some of the OMCs don't even have to exist, right?
Exactly. If you go to the structure of their 4 stations, you realize that these people do not even deserve a license.
Yeah.
Some are located in an unapproved localities, in communities and areas. Just this past year, we've heard, including this morning, some fuel tankers catching fire, explosive all over the places. What is the OMC doing about it? How are they ensuring the regulations and standardization of various fuel quality? Trust me, if you're using a vehicle, you can attest with the sound of your engine, the quality of fuel you receive or you buy at a particular pump. Some of them, when you buy, you tell you that your engine is dancing different like Baja, because it's, we are in a Ghana month. Differently, we have to ensure that that protectionist policy is there, not just to the OMCs, but to the consumers. How do we benefit with all this? Surely everyone is expecting fuel price to go up, because the factor, freight prices is an element in the whole refinery pricing as part of the formula. All this will contribute to inflation going upwards. Already, the simple food inflation subsectors we felt just today. Let's hope to get more.
Now just imagine that we are all selling one product. You have made it a point that you have refined that product to the extent that it is benefiting your consumers.
The investment you've made.
And that your refinery is a bit expensive, and because of that, your consumers can now afford that better product. There are those who are selling an inferior, the same product but inferior part of it. And now there's a price floor that is forcing everybody to actually charge at a certain price floor, that the person who has added some level of additives, some level of refinery, some level of quality to that product that they're selling that same price at somebody possibly who is selling at an inferior price. And many have said that this is not helping the market. Set your price floor, but allow the market to play its game. And if you are forcing to have a number of OMCs, it's better to keep fewer who are quality than to keep over 300 OMCs. And almost all the time, you need to use price floors to make sure that the industry is profitable.
No, but I think the other side of the argument is that only the big players can afford the discount. So the smaller OMCs, or the other OMCs, if you might say, cannot afford a discount. So allowing the discount to go on the way it's going, and we all understand why the discount is happening in the first place, because some market players are struggling for the market share. So once the larger market players are able to offer a discount at some select filling stations, like I said earlier, once it distorts the market because there's no uniform pricing. The NP wants uniform pricing. They don't want.
There's no uniform quality as well.
Well, no. So uniform pricing for one OMC. So if you're an OMC, you say you have diesel for 5 cedis. Whenever I go to that particular OMC, it should be 5 cedis. So if I go to Guel, if they say 10 cedis, it should be 10 cedis. Star, if they say 2 cedis, it should be 2 cedis. But we shouldn't have Star having different prices in different countries, in different areas, because it disadvantages the consumer. which is exactly why the MPA says that, okay, even though discount is allowed, the way and manner which is being used for the past few weeks seems to be, some competition between some
if you're into markets, you understand that. Exactly.
We can go on and on with this conversation.
Because you want demography in various areas changes.
Exactly.
In terms of,
so the point is, if you're an OMC and you say you want to sell below a certain price, give it to all your consumers. Don't limit it to a particular area.
If you're a branch manager of a company, and that branch is performing better than another branch, certainly you'll get bonuses.
Come on.
I disagree.
I don't think that this policy or forcing everybody to sell or discontinue with the discounting policy is actually necessary at this point in time. We are only creating some sort of uneasiness in the market and making other players feel that there is a certain dark force against them, which I don't think that is really helping the growth of the industry.
But if I tell that, we have indication that it was the industry that actually pushed for this. So it wasn't the MPA that got out.
Industry, it could be the majority decision, but definitely if you go to the meeting, there's some OMCs who are not happy with the decision. So if you say it's the industry, you need to ask yourself, out of the 300 OMCs that we have, how many actually voted that we should even go on this route? How many said that, well, let's stay where we are and still go ahead with discounts? But, I mean, away from that, I think we need to start talking about the reopening of the domestic bond market. And, in fact, what we've been asking since Monday or since last week is when government comes into the market to borrow, currently, government has been able to drive down Treasury bill rates to now about less than 6%. When they come to the market, what should be the rate? I want to pick the thought of Caleb first, and I'll come to Winston.
Yeah.
Government is returning. Big sums of money will be taken from the market. Cocoa bills is going to come in. I don't know if it's going to be the same thing, whether they're going to issue ESLA bonds, Dache bonds, or they're going to change the name, because I understand that it's for infrastructure. How will the whole structure be? And what will be the ideal coupon rate when government returns?
So currently with the T-bill market is between 3 months, 6 months, and then 1 year. So if you have, the highest duration for the T-bills now is 1 year. So if you are introducing bonds, it's definitely going to be more than 1 year. Last year when we were in talk with the IMF, last 2 years, when we talked with the IMF, we told them that we'll come back with a 2-year bond first before we start,
I remember we even had an advisory note on that, I think about a year ago, right?
So right now, the T-bill rate for the 1 year Treasury bill is about 9%. So if you are going to do longer term bonds, usually, because now the government is a bit shaky and would not enter the market for about 3 years now, the government will want to sweeten the deal for investors. So I'm estimating that it should be beyond the 9% we are seeing for the T-bill rate, which is the 1 year T-bill rate now. I think the government is going to do about 2 years, maybe 2.5 or 2 to 2.5 years, or maybe 1.5 if they are being very prudent.
And also say government can even go as high as 5 years.
Well, it depends on the trust the market has in you, the confidence the market has in you, because once the market sees that you are credible, you've been paying your debts over time, and also before the government even comes out with the bonds, they have to release an annual and a medium-term borrowing plan. So when they release the plan and investors go through it, and investors say, okay, this is credible, comparing it to your revenue. Remember, last year we did not meet our revenue targets. So again, investors are going to be very, go through the details. And again, want to know whether foreigners are going to be invited into the space. No, because some foreigners might also want...
they suffered haircuts.
Exactly. So, for the fine details, we leave that to the finance ministry. But then I'm thinking that for the reintroduction, it's going to be about 1.5 or 2 years bond issuance. It's going to have more than 9% T-bill rates, interest rates, because the government want more investors to come on board. And if you don't give them too much, they're going to stick with the treasury bills. And the government doesn't want that. So if you're going to give someone below, let's say, 6% for 2 years, do not take that. They'll stay with the T-bills, because T-bills, they can get 9% for 1 year. So I think more than 9%, and then also for about 1.5 or 2 years.
Winston, this is the finance minister who loves low interest rates. In fact, there's no borrower who doesn't have lower interest rate. But I'm looking at the uncertainties surrounding our economy and even the global space at the moment. And it explains why investors in our space are sticking or currently saturated at the shorter end of the market, looking at very short period of time to turn around, get your money, see what other investment is booming for you to be able to actually put your money in. There are a lot of people looking at the stock market now. And you've seen oversubscription, especially in the treasury bill space.
And the coupon payments.
And the coupon payments and all of that. My question is, Caleb made mention of sweetening the deal to actually attract investors. How much will be too low in terms of government's return to the market, and how much will be too high for government to be able to pay, especially looking at the fact that we've not met our revenue target? Investors will be looking at so many things. Although inflation is down 3.3%, you can still see a significant gap between policy rates and inflation rates. All this turn-off point for investors who possibly will still decide to stick at the short end of the market and say, if you want us to lock in for long term, give us maybe 15% or 16%.
Let's look at where we came from. The onset, the first narrative, I was there when the former finance minister, Ken Ofori-Atta, announced the debt restructuring. And the key phrase we kept hearing then was burden sharing. Yeah. The key question to this government is, are they going to have a possible profit sharing going forward? Because the key, what our government will have the capacity to meet a debt obligation as against ensuring that they're able to meet the same debt outlines going forward, especially if they issue the timetable. We are looking at where commodity price comes to play, ensuring there's so much reserves and backups for government to go around ensuring that most obligations are met with available funding at key points in time.
I'm sorry to cut you, but you made a very good point about the exchange rates, because the government can now decide to pay coupons because they are making savings from the exchange rates. So the stability of a currency moving forward again is going to be another thing to look at before investors gain your confidence back.
And they are in a quick upfront to ensure they are releasing those interest on already owed bonds and then doing that quickly before their maturing date. And this is a good sign. One thing I like about how the finance minister is handling things is the fact that he makes sure that the fundamentals align, especially in instances where they have to pay more than they're supposed to pay, and this reduce our debt books. And one thing many are looking forward to, how we're going to have a fiscal council, and which will basically focus on how we manage our debt management. If we don't do that immediately before we go into the full market play, we'll find ourselves playing the high risk ball. And that is very important for us as a country, not just for investors. Already there are sentiments in the market. I'm on the platform and people are asking, is it going to be more risky now, because people have the money. And the lessons have gone globally as how high risk we are from ratings that have come through. But with all this sentiment of how we performed in the last 1 year, now people are quite skeptical. It tells you that now bonds are not totally sovereign and risk-free. You can have a paper, certainly be rest assured that it can be restructured. Ghanaians are now...
It can be haircuts.
You can be bubblized, basically. So Ghanaians are now more prone, are now more advised, basically ensuring that whatever you're holding, there can likely be restructured. Restructuring is now a new doctrine in the government's books. Unlike previously, what our economic books tells us, the government cannot fail.
Can never default.
So that things are changing. So people will now have to diversify their portfolio. Few monies here in the stock market, few monies here in commodities investment, few monies here in treasury bills, and all this are now what financial advisors will give to anyone who wants to release money domestically. So government has done so much with the T-bills without borrowing externally for a year now. But let's see whether it will be the same narrative.
And if Winston and Caleb, I'm looking at the total exposures that came in when we did the DDEP in 2023. And one thing you realize is that commercial banks, in terms of exposure to government bonds, they are number one. Right?
When Winston spoke of diversification, I wanted to ask you that.
Exactly. And you talk about another big player, which is the Bank of Ghana.
And the pension.
And the pension funds, right? Insurance companies. Now, the key question is, with the kind of haircuts that the financial sector got, and we gave you that headline from Dr. Richard Minichine, who said that the Ghana Amalgamated Trust currently, which was supposed to be a savior of the commercial banks, the local banks who find themselves in trouble, is now really looking like a risk for them. And he says that if we don't act now, there's going to be a time that GATT will possibly take over some of these banks. I'm looking at the exposures. If you look at treasury bills, that is, treasury bonds, ESLA, Dache bonds, The total loss the last time we did the restructuring was an estimated 12.4 billion Ghana cedis. That was the total value of haircuts that investors had to suffer because of the restructuring. You go to foreigners who brought in their USD to come and invest here. They suffered some 7.2 billion cedis in losses. Cocoa bills, and we understand Cocoa Board is going to come back to the market this time around, not on bills but on bonds, right? Yeah. Investors who decided to stick with Cocoa Board lost in total 4.5 billion cedis. BOG lost significant amount of money. You put all this together in total, the space lost some 60.8 billion cedis. How do you go to the market and say that, well, I've been able to clean my books, looking at the long term, everything look good, and if I float or if I issue the bonds, there's high probability that I'm going to pay, especially looking at the fact that government simply doesn't want to pay high interest. Yeah. How do we find the balance, finally, before we even leave this space? How do we find a balance by not paying too high and giving the investors that there's assurance that we will pay when the time is due?
So I think it's even good news for us because the interest rates on the T-bills is about 9%. If the government goes too high on the bonds, they're going to get so many subscriptions there. Yeah. And we've already seen some restraints that the finance minister is kicking back some of the T-bill subscriptions. Yeah. This means that the government does not want to take too much.
Yeah, because of the short turnaround time, right?
Exactly. So with the bonds, the government needs to stick to that principle it has set with the short end of the market. Once that happens, more liquidity is going to private businesses. Once it goes to private businesses, we know expansion, industrialization, all of that. So the government needs to make sure that it doesn't give out too many bonds. It sets targets, it sticks to the targets, it doesn't go overboard. We were in that situation because the government went overboard. Yeah. There were no forex coming in and the government needed some money. So which is why the T-bills went as high as 27% at a point because the government didn't have the money. Revenue was not doing well. So they had to focus on the T-bill market. So I think it's good news for us because so even though people are a bit skeptical, people will still go for the government bonds. When the government bonds comes out, the finance ministry will make sure that they don't go overboard, stick to their targets, and then leave some of the liquidity on the market so the banks can do what banks are supposed to do and give money to businesses.
I want to delve in. When this happened some time back, the narrative was the Russian-Ukraine war. Let's not forget, we are also in another war. And if we don't manage that risk, the external risk component, it's likely to go ahead. And the governor of the Bank of Ghana made mention of this external risk consistently during the last MPC. We're waiting to see the next MPC, what they take into consideration.
Well, definitely, our advisory last year said that, well, whatever happens in the local bond market space will create a perfect picture for investors who are outside. Our return to the Eurobond markets, if only we'll go anywhere, will depend on how disciplined we are when we start issuing bonds. Investors who used to buy bonds used to enjoy some 19%. We are observing the space. Government will come very soon, issuance calendar out, and we simply do not know the coupon rates yet. We'll be observing the space, how government is going to offer investors. Will investors decide that we want to stay at the short end of the market and possibly give less of our liquidity to the long term or the medium term end of the market? We simply will find answers here for you on Beyond the Numbers on previous show. But my name is Isaac Ofieje, and I did this with
Winston Taki.
Definitely.
Caleb Ziblin.
See you on Friday, 3:30 as we wrap up the trading week.